Hello and welcome back to the Taxtron support channel. Today, we are covering an important topic, declaring the principal residence of a deceased spouse. First, let's talk about what we mean by a principal residence. In Canada, a principal residence is the home where you or your family members usually live during the year. It can be a house, apartment, condo, or even a cottage. The main benefit of declaring a property as a principal residence is that you're typically exempt from paying capital gains tax when you sell it. But when a spouse passes away, what happens to the principal residence exemption? If the home was owned jointly or if the deceased spouse was the sole owner, you may need to declare the principal residence in their final tax return. This ensures that the capital gains on the property, up until the date of death, are exempt from taxes. When filing the deceased spouse's final tax return, you will need to complete Schedule 3 of the T1 return, which is the section for capital gains. Here's what you need to know. Step 1. Identify the year of acquisition and confirm the home as the principal residence. Step 2. Calculate the capital gain, if any, from the date of acquisition to the date of death. Step 3. Declare the property as the principal residence for the relevant years on Schedule 3 of the final return. Most importantly, when a spouse passes away, the ownership of the home often transfers to the surviving spouse. In most cases, the transfer of ownership is not taxable, provided that the home remains the principal residence of the surviving spouse. This is called a rollover. When you sell the home after your spouse's death, the capital gains tax may apply to any increase in the value of the property from the time of their death until the sale. However, you can still claim the principal residence exemption for the years that the property continues to be your principal residence. If the property was your principal residence for all the years you owned it, both before and after your spouse's death, then the principal residence exemption will cover all capital gains on the property, meaning no tax will be owed on the sale. Important considerations. Time of sale. The exemption applies as long as the property was your principal residence for every year you owned it, and that of your spouse if applicable. If the home remains your principal residence after your spouse's death and you sell it later, the full exemption should apply. Multiple properties. If you and your spouse owned more than one property, you can only designate one property as the principal residence per year. Ensure you are correctly designating the primary home. Change of use. If the property stops being your principal residence, for example, you rent it out or use it for business purposes, this could affect how much of the exemption you can claim. After filing the final tax return for the deceased spouse, you may also need to apply for a clearance certificate from the CRA. This ensures that all taxes, including capital gains from the sale of any properties, have been paid before the estate is distributed. Without this certificate, the executor could become personally liable for unpaid taxes. Now, let's jump into a practical example using Taxtron Web. So, let's get started by logging into the Taxtron platform. Head over to the T1 Clients section and select an existing client. Let's create a new return for clients named Chris Helen and Jenny Helen. Chris Helen's spouse Jenny Helen passed away on May 2, 2023. We will change Chur's marital status from married to widowed and enter the date of spouse passing away. Before proceeding further, make sure the personal information section under Identification is complete and accurate. Jenny's marital status remains married as on December 31, 2023. We will now proceed to file a return together. Next, navigate to the section on information about your spouse, Jenny's information. Answer yes to is this a deceased taxpayer's return. Now enter the date of death May 2, 2023. Next, proceed to declaring sale of principal residence on Jenny's tax return. In this case, the property was owned 100% by Jenny. Since this is her final return, the sale or transfer of their principal residence needs to be reported. Scroll below and answer yes to in 2023, did you sell your principal residence? Next, if Chris and Jenny had any income, proceed to enter income for both. In this example, I have considered both Jenny and Chris having T4A income, as shown in the video. Next, navigate to the Sale of Principal Residence section for Jenny and update all information on the T2091 form. Enter percentage of property owned by Jenny. Next, enter the address of the property sold. In this scenario, Jenny acquired the property in 2020 and sold it in 2023 for $500,000. Next, enter the total number of years after 1981 the property was designated as a principal residence. 2020 minus 2023 is 4 years. Taxtron Web promptly calculates the number of years owned and designated. Download record keeping from Review and File section and go to the T2091 form. However, since a principal residence is typically exempt from capital gains tax, this will not result in any tax owing. So in case of death, if the person has the principal residence, it will be reported on Taxtron's Sale of Principal Residence form, but ultimately the form that sent to CRA is on form designation of a property as a principal residence by the legal representative of a deceased individual. If the property is transferred to the surviving spouse upon death, the surviving spouse may be eligible for the principal residence exemption, which can exempt the property's capital gain from taxes for the years it was considered a principal residence. And that's it. Once the information is filled in, Chris has properly declared sale of Jenny's principal residence on her final tax return. Now, let's walk through with another example of selling a principal residence where deceased spouse who was the sole owner of the home, and incorporate the spousal rollover concept while acknowledging that the property was not designated as a principal residence for all years. Tom and Rachel purchased their principal residence in 2010 for $400,000. They lived in the house as their primary residence until 2018. In 2018, Tom passed away, and the home was transferred to Rachel under the spousal rollover, allowing her to inherit the property without immediate tax consequences. After Tom's death, Rachel continued to live in the home until 2021 but then decided to rent it out. The home was sold in 2023 for $900,000. Rachel wants to claim the principal residence exemption for the years it was their primary residence and determine any potential capital gains tax owed. Create a new return. Before proceeding, kindly ensure that the personal information section under identification is completed accurately. Let's complete the taxpayer information: first name Rachel, last name Test, date of birth, and SIN number, and select the marital status as widowed, as Tom passed away in 2018. Since Tom passed away in 2018, the property is deemed to have been transferred to Rachel through the spousal rollover. This means that Rachel inherits Tom's share of the home without triggering any capital gains tax at the time of his death. Rachel is selling the property in 2023. Next, let's go to Rachel's address tab and answer yes to the question, in 2023, did you sell your principal residence? Then, navigate to the Income tab and select the Sales of Principal Residence section, entering the property address as shown on the screen. According to this scenario, the property was their principal residence for the years, from 2010 to 2021, a total of 11 years, including the spousal rollover years. For the years it was rented out, 2021 to 2023, it will not be eligible for the principal residence exemption. In the principal residence drop-down box, select some but not all the years owned. Enter the year of acquisition as 2010 and the year of sale as 2023. As stated in the scenario, we will enter the proceeds of disposition as $900,000, the sale price. Next, it will ask for the number of tax years for which the property is designated as a principal residence after 1981, which will be 11 out of 14 years. As discussed earlier, the deemed acquisition value of the property on the date of Tom's death will be the fair market value at that time, assumed to be valued at $600,000 when he passed. For the adjusted cost base, enter the new value after rollover as $600,000, the value at the time of Tom's death. If you have any outlays and expenses related to the disposition, you can enter them here, otherwise, skip this part. Now we have completed reporting the sale of the principal residence. Let's navigate to the Review and File section and print the record-keeping documents. Scroll down to the T2091 form, Designation of a property as a principal residence by the legal representative of a deceased individual, and go to Part 1, where it calculates a net capital gain of $42,857. How is this calculated? The property was Rachel and Tom's principal residence for 11 years. The property was owned for 14 years. Use the formula for the principal residence exemption. Here, the years as a principal residence will be selected as 12 instead of 11, as the +1 rule from CRA applies. This means if the homeowner has moved out of the home and rented it or left it vacant but has not sold it yet, they can still designate the property as their principal residence for one additional year after moving out. Now, subtract the exempt portion from the total capital gain. Net capital gain equals total capital gain minus exempt gains equals $42,857, approximately. So, you can see the taxable capital gain being reported on Schedule 3, line 19,900. That's all for today's video. Thanks for watching.